My first task was I assigned myself to find the worst case scenario, to find the one withdrawal rate that could survive or had survived under all historical conditions. That turned out to be the unlucky person who retired in October of '68.
The reality of this thing is there's the academic research and then there's the applied practice of saying, how do you actually use this thing with the real live person across the table from you? Because nothing in those papers indicates what actual life is like.
Do you need to take more risk when you've already won the game of you've saved enough money, you have the withdrawal, you have everything that you need in life and want, and more money doesn't change the purpose or your happiness level?
Matt, so you and Justin were lucky to talk to what I guess we would consider a legend, right, in the financial planning space. I mean, I'm not in there, but I would guess this guy is considered a legend in the financial planning space.
This guy is a legend. Like there's no way around it. Nobody doesn't know the 4% rule. Nobody hasn't talked about it, been asked about it, said it. If you're anywhere near financial planning, you've encountered this rule. Bill Bengen is just one of those OGs that we throw the name out there, but it's really cool to be across the screen from him for an hour or whatever. Very, very cool.
Yeah, we were really lucky to get him on. And I don't think you and I are equipped necessarily to handle the full conversation we have to have today, because we're going to get into the 4% rule, how it works, how it's used, because it seems like a simple thing. Oh, 4%. But then when you dig into it, there's like a million things behind the scenes that you need to understand to be able to do this. So we've brought in Ben Tuscai, Director of Planning at Sunpoint Investments, with you there, Matt, and he's going to help us get through this.
The reality of this thing is there's the academic research and then there's the applied practice of saying, how do you actually use this thing with the real live person across the table from you? Because nothing in those papers indicates what actual life is like. And Ben lives in the trenches of this all day, every day, running numbers like this. So perfect add-on to play some Bill Bengen clips and talk through how you actually use the 4% rule in practice.
Well, Ben, thank you for coming and joining us here.
Thanks for having me back. It's been a while. I feel like I was maybe a little bit disappointing and I haven't been back. It's going back to 2024 at this point, maybe early 2025, but it's been a while.
It was, yeah. We used to do a lot more financial planning stuff on the podcast, and then the YouTube algorithm decided it did not want us to do more financial planning stuff. But now we're back into it. So we appreciate you coming on. So let's start with.
Are we going to do Mr. Beast games? Can we put Ben in a sandbox and light him on fire or something?
Hopefully we won't lose the tens of millions of dollars that apparently Mr. Beast games actually lost. From what the financials have shown after the fact.
Well, let's show him the 4% rule then.
Yeah.
Where do you want to take us off, Jack?
Mr. Beast maybe could use the 4% rule, but we're going to start off with Bill. And we talked, one of the first things we want to ask him about is sort of where this came from, why he came up with this, what the 4% rule is. So here's Bill talking about that.
I just adopted things which I think were reasonable based on what my clients had told me, what they're expecting. A lot of them were saying, I might plan for at least 30 years. So I use that number. My first task was I assigned myself to find the worst case scenario, to find the one withdrawal rate that could survive or had survived under all historical conditions. That turned out to be the unlucky person who retired in October of '68. Just ran into a buzzsaw of multiple big bear markets followed by high inflation, which forced them to increase their withdrawal. Just devastated their portfolio. Something I hope we never see again. We start off by assuming that you want to plan for 30 years of withdrawal, that you take from a tax advantage account. That's when I have a zero balance in the account at the end. And that your asset allocation is appropriate. I recommend now 65% stocks for most people, 20 or more years planning horizon. Those are some important factors. And the 4% rule works. You take 4%. If you have $1 million, the first year your withdrawal would be $40,000. Then you throw the 4% away completely. And every year, treat it like Social Security does. Give yourself a cost of living adjustment.
Do you think that it seems like in talking to people, a lot of people forget in the original study that you were supposed to throw the 4% away after the first year? Did you run into that a lot? A lot of people confused by that detail?
Yeah, that's something I run into today. There is a legitimate withdrawal scheme where you take 4% of your portfolio every year, but it doesn't work. It doesn't generate as much income as the way I describe it. I use percentages because I want to increase the general applicability of my research. So somebody with $1 million, somebody with $10,000 could use it, you know, equally. Yeah, I just naturally thought in terms of percentages. You know, I didn't have any marketing goals at the time. I was quite frankly just doing that research for my clients, you know, something in-house. And eventually I shared it and a little hick broke loose. Yeah.
What do you think people mean when they say it? What do you think they're missing when they say, I'm using the 4% rule?
Well, I think probably two things. One, they think it means taking 4% out of your portfolio each year, which not. It works more like Social Security, where you take out 4% the first year and then give yourself a costing of living adjustment each year after that. And the other issue is that I think they apply it as a first attempt at what their retirement plan should be. From my perspective, it's probably one of the last things you should look at because there are much higher rates available today.
What were some of the other things in the years that you discussed? Actually, just lay out the way the original study was conducted. I think this is underappreciated, how you studied this.
Well, I looked at across all historical periods, which, you know, going back to 1926 is almost 100 years of data. And there are just certain periods of time which stand out. One was 1968, which was, you know, combination factors. Another was 1937. It was like a 50% bear market in 1 year, which is pretty awful. And of course, the 1929-32 situation, which turns out is not the worst case because it was a deflationary period. So investors were actually able to increase their withdrawals, which partly offset their huge losses. It's hard to imagine a bear market like 1929-32, which lasts, you know, almost 3 years, and declined stocks by 90%. That's something we haven't seen the parallel of, and I hope we don't anytime soon. 2008, 2009 was bad enough at almost 60%. A lot of people lost, a third of their portfolio value for that. And who knows what the market will bring us in the future.
Yeah, guys, what I thought was most interesting, and I didn't even know this until I watched the interview, is like, he wasn't like, this wasn't some academic researcher that was going in there being like, I need to figure out what like withdrawal rates a portfolio can sustain. This was somebody who was doing planning in the real world. It was like, why does this not exist? Let me go make it.
Yeah, I mean, I think that when I think about when this rule is like most applicable is obviously around retirement for many of the clients that we get to work with. But when you think about the history of it, you're thinking about what's going to work over all of these time periods and the variabilities of markets. And what most people are trying to solve for is like, what could I take out and not think about? Like, how am I going to, like, what's the psychology behind it? And that's really what Bill solved for us today, is the psychology behind what's the withdrawal rate? What's the amount that I could take out without having to like stay up at night and worry about maybe necessarily what a market is doing in any individual time period, at least.
The critical part there is what I don't have to worry about, because he approached this as a practitioner, which is a really cool citizen scientist thing that's going on here. He didn't go in with the supercomputer and a bunch of research assistants to calculate this number. He was like, I am disappointed in the advice industry that is my peer group and how they answer this question. Let's sharpen the pencil. Let's look at some historic periods on what I have. I'm going to assume people are going to be around for 30 years. And actually, because I don't think we really explicitly stated this, I feel like 1994 when he does this, Ben, do you want to run through those original assumptions that he made?
Yeah. And I think too, to point out, like, think about where the industry was back in 1994. Like, we're talking about it from like in 2025, planning is like on the forefront of most of what we do today.
Not just A-share mutual funds?
No,
I want that
like
front-end load.
Exactly. Go back to 94 for a second and think about what the focus was when you're working with a financial advisor.
Yeah, there's like no e-money and stuff back then, right?
There's no technology.
There wasn't even an E-Trade baby. It wasn't even born yet.
Microsoft Excel was like, I don't even know what date that came out, but like, think about all the functions that we used to use in Excel that's like now just part of technology every day. So like, you really have to like strip out all of that stuff and realize, wow, this was really complicated for what, you know, Bill Bengen came up with. So, and yes, Matt, to your point, a practitioner going into the lab creates this really unique scenario, which is why I think this outcome has been so strong and why everybody knows the 4% rule today. But Simply what he did was he was trying to create a safe withdrawal rate with a 50% US stock portfolio and 50% government bonds, and have a portfolio last for roughly 30 years, which was the estimated time frame for when somebody retires until they pass away. And also depleting the portfolio was like within the parameters of the research. So it's not withdraw 4% and have like an annuity, which we'll talk about in a little bit, where we'll have a principal balance guaranteed at the end of it.
So the idea is I want to never have a scenario I run out of money. So the question is, what withdrawal rate can I take where if I started on the worst date possible, I'm still not going to run out of money?
Correct. Yeah, that's exactly that's what the research is behind all of this. And I know that we'll get into the practicality of all, like how this actually works in client conversations, but from like the 30,000 foot view, that's where the research started.
And then I'm going to adjust my withdrawals for inflation every year, right? So it's not I'm setting 4% and then it's over. I'm going to adjust that every year as it goes.
Correct. And that's a simple calculation, because at the end of a year, you could simply just go into like, okay, what is the Fed going to adjust Social Security to? Like, what was the inflation adjustment on Social Security? You're just going to strip out that cost of living adjustment for there and calculate that into what you adjust your withdrawal rate for the next year on.
Just before we get into details, I want to talk about a little bit about how this might be used in a real world, not completely in detail, but like Matt, you've always referred to this as a rule of thumb to me. Like you guys aren't bringing in a client and being like, let's look at what 4% of your portfolio is, and that's your withdrawal rate. And then every January 1st, we will adjust this for inflation. Like, how do you guys think about this as planners in terms of how you actually use it?
I want to say on the original research too, this idea and what Ben was just getting at of it's retirement time, we're going to take a snapshot. And we're going to take a snapshot of the values of the accounts and whatever we're looking at. We're going to take that original 4%, and then we're going to treat it like that number is now gospel. So every single year, if it's $100,000 a year that you're able to get, every single year it's $100,000 you can take. Market goes up, market goes down. To Ben's point, you can sleep at night. And then once a year, we're going to revisit that number and apply a cost of living adjustment to it. So it's kind of like you take the snapshot, you do the number once, and then you give yourself an inflation adjustment over time. And theoretically that lasts, 30 times out of 30 with a couple of caveats in there on his failure periods and how he tested that. So as a rule of thumb, what this is great to do is just illustrate a starting point to a more detailed conversation. Because the reality is you do that math, you figure out, you take your snapshot, you say, here's what I can take. And then there's a bad storm and you have your roof is gone. Or then, your kid needs help, or your kid's getting married and you want to help out with a wedding, or somebody has a baby, or somebody has a healthcare crisis and you have to deal with it. So that rule of thumb starts out as a way to say, here's a baseline proxy we can use. But then in the real world, it's life is happening constantly. It will not stop happening until you die. And that's going to throw all your basic assumptions, not out the window, but put them to the test. This rule of thumb is just how we set a track to then measure if we're actually on. Is there anything else you would add to that one, Ben?
Yeah, no, I think it's a starting point. And this is for like a practitioner, it's where once we go through expenses for like, hey, what's like monthly costs for you, portfolio value, immediately, if we just take 4% of that, that's usually and if we're not including Social Security in that yet, I have a really good feeling at that point of what retirement is going to look like and really what flexibility in retirement is going to look like. So we start there, and then it kind of, that informs me right away of how is this all going to work in the event of health crisis? We want to help the kids, wedding, all that stuff that Matt just mentioned.
And you can do it on the calculator on your phone. You don't need to pull out the fancy calculator for it, right? Like that's the other really great part about this.
We're not going to break out the fancy calculators in this podcast, Matt. It's too much for us.
You watch out now. I got mine right here.
But to your point, I don't do the kind of planning you guys doing, but the other day, I was talking to a client and I just saw what he had and what he was withdrawing, and it was like 2%. And so it's just a quick snapshot to say, all right, this person's in pretty good shape.
Yep.
And if you do that calculation, that's 10%, you can be like, well, we might have some problems we got to address here. So it's good from that perspective. It at least gives us a number to see in general, are we in the right vicinity of where we need to be?
I think that's where you have to use this. This is it's an applied guide. And I don't think it can be use too much further than that. And that's not to like say, Bill, all of this was just for like a guidance reason, but like the practicality of it, it's unique to the person's scenario that they're working within. So to your point, Jack, what you did, that's what I do. Is like, and I see that 2% number, and I'm like, oh, then it's a positive. Then I'm going into the next client conversation saying like, actually, you need to spend more. Like, you need to spend more. Or like, and the best is like always the response of like, I need to spend more. Like, what would I spend more on? I was like, that's what we're going to figure out today. Like, there's like, and going through like some of their philosophies. So like, that's where the rubber meets the road. So I what you're saying is exactly what actually happens in real life.
Why are these inflationary periods? Because one of the things you talked about in there, and it surprised me, like if you had asked me what the worst period was for the 4% rule, I would not have guessed from 1968 on. I mean, that was certainly a very bad period, but there were worse bear markets. But I guess this coupling of inflation with the bear market period was really bad. So why is that so bad for like a rule like this?
Well, I mean, you have everything gets more expensive and your portfolio is declining. It's like, it really wasn't that long ago, really. Just think about 2022. Matt and I were talking about it like in the prep before the podcast. Like if you retired at the end of 2021, sure, you like experienced that COVID dip. Inflation started to take off. We got introduced to the term transitory, and then that didn't happen. And then 2022 hit and everything went down in a diversified portfolio in kind of unison while everything equally got more expensive. So the reason is you have two factors working against you at the same time. So if you're saying the 4% withdrawal rule is like the guide here, you need to withdraw a lower amount because we have a lower value to start on, but we also need to adjust the income that you're going to need for the cost of living and inflation. That's actually going to draw down the portfolio a little bit faster, which actually starts to push us close to where Bill talks about the failure rates.
Well, thank you for that. Because Matt, I just needed to do my bearish title, like inflation will destroy your retirement. So now I can put Ben on there. Now that I got him to say that. So now we're in good shape for the rest of this.
When do I pause for the Mr. Beast faces? When do we do the gasping looks? But that point about the inflated costs against the declining portfolio value, that's the actual part that scares us as planners too. And that's where when we start to introduce the idea of more diversification than just US stocks and bonds, it's how many ways can we segment this so that the likelihood of any one thing that we own going down is greater, because that's the diversification thing. I think it's Ben Carlson, right? The diversification means you hate something that you owned.
Correct.
That's the test of diversification. But if we have multiple pots to pull from, at least we have flexibility. Because when you go through that late 60s through the 70s period and you deal with a largely sideways portfolio on top of raising costs, that 4%, that's not a rule of thumb. I'll quote the Boondock Saints. It's not a rule of thumb. That's a rule of wrist that you need to beat down that problem. That's scary stuff.
And so playing with this idea that's a rule of thumb, it's something that can change, potentially over time. And certain things like market valuations might play a role in this. You might change the portfolio you're investing in. There's a lot of different things that can change. So here's Bill talking about all that.
If you look at the overall market valuation, let's say you take something like the CAPE ratio or the Shiller PE ratio, which is elevated given where it's been historically, how do you think about strategies or ways that might take stock valuations into consideration? And also, I guess, the bond yields in terms of like trying to come up with these safe withdrawal rates?
Now, I haven't really examined the effects of bond yields so much because they tend to be fairly stable over time. The volatility is on the equity side of the equation. And determining you need to have a healthy percentage of equities in your portfolio to get one of those higher withdrawal rates. And in my book, I talked about 55%, but I recently upped that to 65% because it works better almost across the board for all retirees and really gives them a lift. Like I was estimating based on market valuations and inflation, using a 55% stock portfolio, the withdrawal rate in today's environment would be about 5.5%. When I go to 65%, that goes up to over 5.8%. So that's a worthwhile increase. And I don't think you're taking much risks to get it.
Yeah, so that's a pretty, like you said, substantial increase from the 4%. So how would you view taking something like the Cape? And I think one of the pieces of research you've done is looking at market valuations and then looking at different inflationary regimes and trying to kind of embed those in a framework that would allow someone to estimate what that withdrawal rate is. So how would that framework basically be constructed?
Essentially, put inflation first, which is I learned after 25 years of failing to come up with a close number. Once I put inflation first and put stock market valuation second, everything flowed. Stock market valuation is important because if stocks are very expensive, we're probably near a major bear market. And major bear markets around retirement are damaging to your withdrawal rates. Inflation, of course, causes you to increase your withdrawals, which can be even more devastating because they're locked in for the rest of retirement.
One of the, I guess, enhancements here that you are suggesting is the incorporation of, different types of stocks. So mid caps, small caps, maybe even micro caps to get that equity return, higher than maybe what the broader market would give you over time.
Yeah, if you look at my research, I've had 3 different allocations I work with, and every time I went to a more diversified portfolio, it increased the withdrawal rate. The last time I went from 4.5 to 4.7.
So my first question, I guess, is how do you guys think about, when you're thinking about withdrawal rates, how do you think about the current market environment? Because, at any point we do have we actually have some yield on bonds now, but we have a bond yield that exists. And we also have like a market valuation. Is the market expensive? Is it cheap? Does that impact a lot in terms of how you're thinking about withdrawal rates for your clients?
Ben, you take this first, and I think it's useful to actually say this. We use software for this. This isn't just something where the rule of thumb part of where you can calculate it, forget, not even the fancy calculator cuts it for this one. We need fancier calculators. And it's the combination of the capital market assumptions and the software we use. So maybe, do you want to talk about how you actually do that calculation? If somebody's like, Ben, I'm retiring in 3 years. Here's what we have right now. Here's what we think we'll have. How does that all factor together? And then I'll comment a little bit on some of the historical periods that we've dealt with.
Yeah, this one is, you have to go past the 10B2 plus that is handy to keep with you. But
I'm impressed both of you guys have those just sitting next to you.
I use it actually a fair amount.
Same.
Part of the CFP training course, you have to use this on the test. So
somehow the quant guy doesn't have the calculator,
right?
And the 2 financial planners do.
Because you know how to use a computer.
Yeah. The thing that we're talking to right now, you don't really need this thing. So the reality is, I actually don't need that. I use eMoney, and that's the software which is really, everybody calls it financial planning software. It's just a giant calculator at the end of the day. It's inputs and outcomes, and that's how you get all of these planning assumptions. So what we're trying to do is, if in Matt's scenario that he just brought up, is okay, I'm trying to retire in 3 years, and that's the goal. We have to get the assumptions right for, market return. And we always try to err on the lower end of market returns when we're doing most of these scenarios. Because it's connected to a reporting software, it's oh, well, this whole portfolio has returned 10% a year over the past decade. It's we need to go in there and manually retract that information, because what happens then is, you're oh, they could withdraw 6% a year or 8% a year and never run out of money. We have to bring that back down. So in the planning assumptions, in eMoney, we have the ability to say, all right, what happens if we had a 5% rate of return static over the next decade? Or what happens if inflation runs rampant for an extended period of time? Those things are easily, to calculate within the software and say, do we have enough based on these expenses? And I think that's where really the rubber meets the road. And maybe the one from the portfolio side, and I know this gets talked about a lot publicly, is a little bit more of that barbell approach. Bill uses government bonds when he started this back in 94, but sometimes having a significant cash buffer that's going to get you through maybe 12 or 18 months, especially immediate retirement, go back to end of 2021. If you had a big cash buffer in 2021, that would allow you that entire 12 months period for your portfolio to recover before you actually needed to draw on any of the principal of the actual investments.
This whole idea of if equity valuations, if you're looking at a CAPE, that's 2 standard deviations above the average, you should probably have some way of discounting your forward expected returns. Likewise, if it's 2009 and interest rates are now at 0, you should have some mechanism of discounting your forward expected return assumptions. And to Ben's point, what becomes really important here is to say, here's our baseline capital market assumptions and how they work with the plan. But then on top of that, let's run a couple of other scenarios, because we don't want to just look at that one scenario in isolation, because we know we're not going to pick the one spaghetti noodle out of the pot that's full of spaghetti noodles and say, here's the future. Like, I picked the right one. Obviously, we have a fancier calculator than your phone calculator to do this, and it's in a computer. Jack Forehand would even approve of this thing. We can't do that. So what we can say is like, okay, if the returns come back and we go, we're going to do an 8% return. I'm just making up a number. An 8% return going forward. Well, let's also test what happens if it's a 4% return going forward. And let's also test if it's where the inflation rate might be totally different. People are worried about healthcare costs or long-term care or the cost of their housing insurance or something else. Lots of weird stuff in the post-COVID era has become very pressing on people's returns list. We want to be able to model out a number of those scenarios to say if bond yields are lower or equity valuations are higher, or if different things happen in the world, how's the plan likely going to respond to that? And where do we think the flexibility comes from in each point of stress?
I think we should spend a second talking about sequence risk here, because it seems to me like, as someone who likes to make everything variables, obviously as a quant guy, it seems to me like I've got 2 important variables here. I've got my return and I've got drawdowns. And I think what a lot of people miss about this is they say, oh, the stock market returns 10% a year. I should be able to withdraw way more than 4%, but they miss this sequence risk component. So can you guys talk about that and why that's so important?
I think actually that's one of the most important. I think there's 2 factors. So I'm going to add something to the sequence of return risk here. Sequence of return risk is even more important when you have fixed debt going into retirement. If you have fixed debt, there's no way that we could say, hey, Jack, don't go on that vacation. Don't pay your mortgage this 6 months while the market's down. Like, that's totally off the table. No,
Jack, I know you're trying to go on vacation and not pay your mortgage again, but that's not good advice.
Not sound advice. So it's the flexibility to deviate from the plan is what creates this probability of success that we often talk about, which just takes us, obviously into the Monte Carlo side of things. But if you couple that with sequence of return risk, those are the 2 of the big factors that I look at. And sequence of return risk, just as a principle, is saying, what is the risk that the first several years after this large decision, what we're talking about is retirement here today, after retirement, that the market is going to, go sideways on us. Again, I keep using 2021, end of 2021 as an example. You retire into a bear market. That's the risk that could totally shift the plan and could potentially blow up this 4% rule if it prolongs for too long of a period, because you're drawing on a portfolio that's going down, potentially while inflation is continuing to run rampant, which we've seen in a variety of scenarios.
And that's right. And that's because people always say, well, the market's going to come back. And they're right. The market will come back. But the big variable you just explained, that's the big difference here, is you're pulling money out while it's down. Right. And so it can't come back to the extent it could have if you had your whole portfolio. And that's why it really destroys people's retirements if you get it wrong.
Right.
And that's where you need stabilizers. Just like our favorite government policy expression of automatic stabilizers or finding out stabilizers for the economy, you need that for your portfolio. And so if once you start a strategy where you are spending money instead of accumulating money, you need to have diversification. You need to have elements of stabilization inside of that portfolio so you can deal with it. And people are different in how they deal with it. Some people are going to be more comfortable going like, oh, I'm taking this out of my equity position, even though it's going all over the place. And I'm not worried because I believe it fully comes back and I don't ever sweat that stuff. Other people are going to be really, really nervous and say, if I don't have that fortress, that vault of cash to go to, Because when stuff is bad, like I'm willing to close my eyes and not open that statement, but I need enough cash to get me through when you tell me it's okay to peak again. Everybody exists on that continuum.
This is why, Matt, I don't just hold the 4X NVIDIA ETF. I also hold the one that pays 60% yield against NVIDIA, because that gives me a nice balance in my
You are diversified.
Things go wrong.
You are diversified.
That's the two holding model that Bill was talking about, right? Was that?
I think
Yeah, exactly.
That's what he used.
This is going to be the new 14% rule book is going to be coming out shortly, which is going to be have those two assets in it. But anyway, so let's talk about his changes to the portfolio, because he started with the 4% rule, and now he's made some adjustments over time. The idea of, if I want to create a higher withdrawal rate, that's why I brought up the idea of returns and drawdowns, because those are really the variables I'm playing with. Like, if I want to have a higher withdrawal rate, I have to play with those two variables. I can't just try to shoot for some return, with some like leverage tech ETF or something, because the drawdown part's going to get me. And I can't just put it in T-bills because the return part's going to get me. Right. And so let's just talk about, like, how did that portfolio evolve over time as he started thinking about maybe people can withdraw more than 4%?
So, right. So it starts with that I said in the beginning, that the two asset model, which is not the NVIDIA, what Jack just covered, just for clarity on this call. But is the large cap U.S. stocks, which is, look at S&P 500 and, intermediate term U.S. government bonds, 50-50. So only a couple years later, he moved to a much more diversified portfolio. As far as domiciled here in the United States, he added in some small cap exposure and brought the weight up actually from the equity position from 50% to 55%. So, Jack, to your point, maybe extending the risk or ramping up the risk a little bit for better returns, but hoping, obviously, that there's going to be some offsets, so that his safe withdrawal rate went from 4% to 4.5%. And then once we hit, the turn of the century, he moved to a even more updated model, which added in 6 asset classes, but started to look across the globe. So adding international stocks and breaking down the positions from, rather than a huge overweight to large cap stocks here in the United States, to a much more diversified portfolio, which is where we are today with his research, which is closer to like 4.7, 4.8%. So it's really evolved over the last, let's call it 30 years since he's started this.
It makes a lot of sense too. You add more things, back to that sequence of returns risk and diversification concept. If you add more things, the odds that all of them are going to be correlated or going down at any one point in time, you're reducing that risk. And the idea that you should be able to get a little bit more out or incrementally more out in those scenarios, that checks out. And you can introduce, maybe we touch on it later too, you can introduce other stuff into this too. You can take something like this and apply it against what Jared Dillian did with the awesome portfolio or the permanent portfolio, or take your pick. There's lots of different ways to think through this, but the simple idea is, if you own a bunch of stuff and it's not one-to-one correlated, your odds of being able to pull money out without shooting yourself in the foot through various stages of the market cycle will go up. Not to 14% like your leveraged ETF strategy, but you might get from 4 to 4.5. And still, to the point Ben made at the top, I don't have to think about or look at this if I set myself on this track. That is really, really a key part. That doesn't mean actually not look at it. That just means, how do we take that stress level down a notch where we can responsibly check in with this? I don't have to be logged into my phone every day checking the account balances.
Well, that's not the case in my leverage ETF strategy, which by the way, if we did put the safe max withdrawal rate on my leverage ETF strategy, it would be 0. I'm pretty confident that thing is basically guaranteed.
Jack, because you're not trading options against those vehicles. That's where you're going wrong, man.
You're not doing it right. I'll quick, you guys cut this for the podcast if you don't want to use it, but I'll quick tell you, when I was at Vanguard, we did this huge, at the start of COVID, this huge competition where, like, I was on an internal sales team, and you manage portfolio like as a team against like all the other teams across the regions, and then the externals as well. And then the divisional managers were a team as well. Our team won by a landslide. We levered up and we bought, it was TECL. This is not financial advice, but it's a levered tech ETF, 3X levered. And we leveraged our account to buy more of it. And in like a 6-month period, we were up like 390%. And the bank gave us more leverage and we ended the year plus like 900. So like I should have been a PM at that point. I decided to go to planning, but I still think this NVIDIA strategy could work out for you after what I've experienced.
That's why all like those stock picking competitions in 5th grade always teach the exact wrong lesson.
Right.
Because the mathematical thing you want to do in those competitions, you just want to buy the most volatile crap you could possibly buy. And then
you
it
win.
gives you the best chance of winning the competition.
There's one winner. There's all losers. My favorite story, it's a Barry Ritholtz story. It's he gets the cold email in like the crisis or just after global financial crisis era. And it's like, I want to give you $1 million or some relatively large amount of money. I want to give you $1 million. I'm going to give 4 other people $1 million each. And at the end of the next, year, whoever has the best return, I'm going to give the whole pot of money to, fire the other managers. And Barry's response, if I'm remembering this correctly, is basically like, A, no, thank you. Like, I want nothing to do with this. B, the perverse incentive you're taking is exactly what you both described, which is like, if it's either I'm the one winner or I'm one of the other 4 losers, the incentive you've created is to like do the most ridiculous thing possible, because the odds of me losing are that much higher. So I don't care if your $1 million turns into $1.
Right.
I don't care if it goes to 0. But if it goes to 20 million and I win everything, then yeah, it's the wrong incentive structure. It's the wrong question. So what we're trying to do here is, if you have a pot of money that you've traded your human capital for financial capital for over time, you've built retirement, and now you don't want to screw up or lose that nest egg, we are basically saying, check all those strategies at the door. We need a responsible way to take stuff out of the piggy bank here without ever breaking the piggy bank. And that's just an entirely different mindset.
Yeah, Barry's competition is like the fiduciary duty meets DraftKings or something. And like the fiduciary duty has to win in that scenario. Unfortunately, the business.
That's unfortunately, a great analogy for it.
So anyway, let's go back to a clip here at Bill. This is interesting. He had a chart in the book that was talking about the sustainable withdrawal rate, or I think he called it safe max, versus the equity allocation. So here's him talking about that.
So in your book, A Richer Retirement, you have a number of charts and tables, and it's very data driven, which Matt and I can appreciate. But I'm curious, is there like 1 or 2 charts that really stand out to you that are like, this is like kind of the most important thing that, you really want? Like, if you were to highlight like the top 2 or 3 charts or data sets in the book, like what would you, where do you think you would go with that?
Well, one of the charts would be safe withdrawal rate versus asset allocation, which shows clearly that you need to have a certain minimum exposure to equities. And my preference right now is for at least 65% equities. You get out much higher than that, then you really start running into problems with bear markets. They can devastate you. But that's where I would be now.
So yeah, can you guys talk about this a little bit? Because it's an interesting shape to the chart here in terms of the safe max as you raise your equity allocation. But if you raise it too far, it goes the other direction. So can you guys talk about how that works?
So, I mean, this is like the laws of diminishing returns, and this applies across a variety of asset classes when you design a portfolio. You could take the good thing could turn into the bad thing with too much of it. And that's the purpose of diversification. Is you're trying to align a number of different asset classes to, Matt always says this, you should always be apologizing for something in your portfolio. That is a good thing. That is a net benefit. And that's exactly what Bill is saying here, is like, you take too much of the good thing and put it in the pot. And when it turns into the bad thing, it's going to hurt you in a way that maybe you can't recover from. So what he shows in that chart that you just had there is that the diversification benefit is what makes this safe max strategy work. This is how you can get to the 4.7 and 4.8 is a 65% equity allocation that's diversified across large cap, mid cap, small cap, micro cap, and then international exposure as well. Because when one of those things is not doing well, it's likely that something else is doing well. And the same thing when we think about the fixed income side of the portfolio, that other 35%, diversification past just government bonds, especially when things aren't doing well on the equity side. Typically people are running to the fixed income side, and that's where you see valuations and things start to stretch the other way on the fixed income side.
There's a reason they call it safe max. This is where you check your yield max at the door, but also you check return max at the door too. The point here on safe max is back to this idea of we've already traded the human capital for the financial capital. We've already saved the money. So now safe max is what's the safe withdrawal strategy. It has nothing to do with accumulation or returns anymore. Those are components of how much is there to withdraw from, but we want to be able to spread out that risk in a way that we can responsibly remove those funds. As the great Rick James once said, according to Dave Chappelle, cocaine is a hell of a drug. You don't want to have all cocaine as the answer to your problem. You need to take it down a notch. Glad you
What's
appreciated
interesting,
that, Ben.
just briefly on the permanent portfolio, because I think the permanent portfolio is a great example of this type of thing, because you're thinking about the return, the drawdown, and the balance between the two of them. And I was looking at like the research on, does the permanent portfolio lead to higher safe withdrawal rates than, say, and the permanent portfolio is long-term bonds, short-term bonds, gold, and stock. And so you're trying to create something where you have something for every economic type environment. And so the great thing about it is there's very low drawdowns because of those four things. But the research is very mixed in terms of, does that produce a higher withdrawal rate? And the problem there is, again, the return part. You only have 25% in stocks in the permanent portfolio. So yes, you have better drawdown profile, but you have worse returns. And so I think that really gets at this idea of this push and pull that goes on in terms of thinking about building a portfolio with like the maximum safe withdrawal rate.
Yeah. How long are you, especially if you're the one giving advice, how long are you able to endure looking like an idiot? Because, and just use the gold component. That gold component went from being talk about apologizing. You better have a bunch of gold bugs as clients if you're dealing with gold for the period up until about 2 years ago, 18 months ago. And all of a sudden, within a 2-year clip though, gold goes from like being embarrassing against the S&P 500 for the last 20, 25 years to like tying and I believe outpacing the S&P 500 for those periods of time. So the brilliance of those strategies are you've got a bunch of stuff that's not going to give you returns in the ways that stocks tend to give you returns. But that lumpy, unrelated mess becomes, you got to figure out the thing that fits you. The portfolio has to fit you and fit your behavioral bias. If you love gold, we should talk about the portfolio, the permanent portfolio. If you're like, gold is stupid and makes no sense to me, that's not for you. Just stay away. It's okay. There's other ways to cut this up.
So yeah, as we move on to the next clip, this is very interesting, these next two things, because one of the things we're seeing is people are having longer retirement periods. We're living longer than we used to. And the other thing is sort of against this conventional wisdom, which is this idea of the U-shaped glide path. So here's Bill talking about both those things.
One of the things that I was thinking about over the weekend, actually, and I don't know, and it was in relation to this conversation we're having today, but it had to do with, I know what it had to do with. It had to do with, I was thinking of AI and sort of what some of these guys that are, really deep thinkers and that are thinking about AI, but thinking about the developments that artificial intelligence will have, not today on healthcare, but thinking like 10 years from now, like the advancements that are going to be being made in healthcare are, going to be significant and might have a very big impact on longevity. So for people that are maybe 40 and going to be 50 in 10 years or 60 in 20 years, if you make it that far, hopefully, all of us, well, you have, Bill, Matt and I do, that these enhancements with healthcare are just going to be like kind of mind-blowing and extending our lives more than we know. And I wonder, like, how do you think about like that a little bit with sort of this withdrawal rate strategy? I know you have like a 30-year time horizon on this withdrawal rate rule, but do you think about that at all, about how we might be living longer and longer as humans, and so our portfolios are going to need to basically be able to withstand even more time?
Yeah, even if we're not living longer, there are a certain group of people, the fire folks, financial independence, retire early. We're probably going to have a very long-term retirement because we're going to retire so early. So it's a really valid question. And I've studied the effect on withdrawal rates of increasing the planning horizon. And as you might expect, as you increase the planning horizon, the overall withdrawal rate comes down a bit, but it reaches a floor. For example, under the 4.5% rule, it came down to Well, actually, on the current 0.7% comes down to 4.1% for, let's say, 50 or 60 years or longer. And then it doesn't go down any more. So if you want to have 100 years retirement, you're probably still at 4.1%.
One of the counterintuitive things is this U-shaped equity glide path. So, an equity glide path is effectively like the exposure you have to equities over time. And the U-shaped aspect of it is about this idea that you reduce your equity exposure more when you're entering, or I guess before you enter and immediately entering retirement, and then you increase it sort of gradually over time. And, that seems like maybe counterintuitive to a lot of people, because if you're entering retirement and you think, well, I have 20 to 25 more years to live off this portfolio, I need to have my equity exposure maybe highest then. But can you just explain that idea of sort of this U-shaped equity glide path and why it could be important for retirees?
That idea originated with two other advisors, Michael Kitces and Wade Fowle. Well, 10 years ago, they published a paper and they looked at exactly the issue you're talking about. What happens to withdrawal rates if you increase equity exposure during retirement? And the surprising conclusion I reached was it was of significant benefit to do that, as opposed to having a fixed allocation. And it seems, like you said, counterintuitive. Why does that work? Probably, as they speculated, and I have to agree, it's because if you encounter a major bear market around retirement and you have lower exposure to stocks, you're not going to get hurt as bad. If you have 45% stocks versus 65, and then the bear markets are all temporary. Eventually they run their course and they're over, and then you can just be piling money basically into a market which is going up. So it's a really favorable dynamic it creates.
Is this where we talk about the live fast, die young strategy?
Do you have that? If you want to bring that up, I'll put it up on the screen.
No, but reference back to the Rick James joke before, and I think it's important. This live long strategy is probably one of the, we talk all the time, and Ben will fill in the actual criteria about this stuff, but we say once you get the baseline plan assembled, the last slide in the planning deck that we put together and refine with people is, okay, now it's time to talk about the known unknowns, which are, okay, what happens if you live longer than you expect? What happens if you do die sooner than you expect, or your spouse does, or whatever the scenario? What happens if you get sick? What happens if you get sued? And inside of that, the plan isn't really robust. I think you've also asked these questions. The live longer one is one of the hardest ones of those four that we have to grapple with. And a huge part, and the one that comes up over and over and over and over again, is because anybody who's dealt with a parent that went into a care facility or lived long and had some, and saw what that, they had to help write that check for how much it costs for the live-in aid or whatever else, they go, wow, that's probably equal to or a lot more than my 4%. My lifestyle is not a bunch of extravagant vacations. It's a lot of bedpans and nurses. And people are rightfully terrified of that live long scenario. And we model that out a lot right now. So, I mean, Ben, how many times do we look out to 100 almost as our default with people now? And then the crazy inflated healthcare costs? That's all the time.
Yeah, I mean, it's a lot of the scenarios. Every time we do it, even if somebody's like, oh, well, like our family health history, nobody's made it past 90. It's like, okay, but that was 50 years ago. Like today, the medicine and the technology, the odds of you making it past 90 are probably pretty good at this point. It's like, we should at least plan to make it past 90. The other thing that I would say, the live longer, it's the retired longer scenario. It's not just because they're living longer. People are doing a better job planning. We're less reliant today on pensions than we've ever been. And a lot of the clients that we work with have been such diligent savers in brokerage accounts and retirement accounts. I have many clients where we have conversations in their mid 50s and they're done. They're retiring because they have the assets. Well, 55 to 100, that's 45 years we need this money to last. That's a really long time to be talking about healthcare costs from 55 to 65 on your own without, any Medicare supplement. And then, of course, if you are in a facility, that we have many of clients where you're writing, did it last week, $7,000 a month in a nursing home facility. So that ramping up the inflation adjustments, we were talking about inflation earlier, inflation on that with a generation that's retiring and heading into homes more often, things that we have to take into consideration when we're talking about planning.
I always think about the great Ricky Bobby in Talladega Nights and his timeless wisdom where he says, between advancements in modern medicine, I'm going to get the quote wrong, between advancements in modern medicine and my high income level, it's not unlikely I could live to 245, maybe 300. And we're getting there though, because you have to extrapolate that forward, and we see big checks going out. And once you've experienced that in the generation before you, you're going to really want to ask those questions of yourself too. And that's really important.
Yeah, what I thought was interesting, like relating this back to safe withdrawal rates is like it does, if you think about he had a 30-year period in his original research, as you extend that, the safe withdrawal rate does fall, but it's not that much. And then it eventually just plateaus and doesn't go down anymore. So it's not like a massive thing, but it seems like it is something that's very important to keep in mind because we're all, I mean, a 30-year retirement is probably potentially not what you plan for anymore.
Right. And I think that's where sequence of return risk is so important when you think about a 30 to 40-year time frame, because that first 3 to 4 years for anybody is important. But I think it's less important if you're talking about 20 years and a large starting point. That's where the guide meets the practicality of like and that's why I had brought up before of like, what are the expenses? What could you do? What levers could you pull in the event of a 2008, 2009, a start to 2020 or a 2022? Like, what could you be pulling levers wise? Those are really important factors to consider, especially over the 30 to 40 year period.
We've also got, I don't know if you guys get a lot of these. We did have, like, it's not as big of a deal now, but the fire people we have too, who are just retiring like very early. You don't hear as much of that as we used to, but that became a thing.
If your diversification was all Bitcoin and you got the ride right,
there's no more fire then. If you're, or actually right now, you're still okay.
You're still okay right now, and maybe you're better than okay. But then the question, when we encounter some of those people, and we've worked with some of them, great. It's just like having a business that took off, or being on board. You signed up at a startup and it was a rocket ship and you got these equity awards. All of a sudden you're enormously concentrated. And even if that means you can retire early, you can retire at 35 or 40 years old or whatever it is, you don't have to work again. If you're overly tied to one security or one thing, back to the idea of that safe max. The safe max is, how do we diversify and turn this into a safe withdrawal stream from the asset base we have? If you have something that's enormously volatile, that's not just going to magically go away because you decided you don't have to work anymore.
Just one more before we go into the last clip here. I want to ask about this idea of the rising glide path. And I think he mentioned it came originally from Michael Kitces. But this idea that people think you should start out with high equity in retirement and kind of lower it over time. And the reality might be the opposite. So can you guys talk about this idea of the rising glide path?
Jack, this is why you wore the blue shirt in honor of Michael Kitces today.
I did, yeah. Yeah.
Okay.
It actually is pretty close to Kitces blue, right?
It's very close to Kitces blue, and we respect the Kitces. So this whole idea of like the rising glide path is just this idea that you have to be aware of what's not just the income level, but the balance between risky assets and non-risky assets, or risk mitigation assets, whatever you want to call them, over the course of that withdrawal period. Because the reality might be, as your equity continues to perform, if your equity continues to perform above the rate of your fixed income, then you have to decide, do I still want to spend all this money? Do I want to leave a gift? How do I want to reshape my thinking if the results come in better than expected? And conversely, the other part of the glide path is, do I want to become more conservative because I'm trying to consume more and I need to bucket that money into something that I have more access in for my consumption? This really ties back to me when I look at this data as, how has your goal evolved from when you initially decided to retire or lessen your workload or be more reliant on your assets, to how do I want to pass away? And am I trying to have the last check be to the pallbearer or the funeral home? Or am I looking at this thing and going, well, it did better than I expected. So now all of a sudden, if I'm not going to need this, I'm not investing for me anymore. I want to adjust that equity amount up later on in life because it's not going to matter to me, but it can make the difference in a future generation.
Yeah, and just to pull up this chart really quick, what was interesting to me about this is this whole idea of the rising glide path where I'm increasing my equity allocation over time. It actually, and it would be counterintuitive to some people, it actually slightly, I think, increases the withdrawal rate you can sustain. because of the way you're doing it. Basically, I think is the reason. But like on this chart here, it shows, you know, it did impact it very much, the safe max, but it was maybe a little bit slightly higher doing it that way.
And again, it's about the core asset that you want to have. And if you need that for consumption in your lifetime, or if you're trying to extrapolate that out further, because it depends what you're spending the money on. You know, it's like, senior citizen discount deflation. You know, now you're going to go, I don't know, you're going to go out to eat an extra time. Like, what are you actually going to spend this on? What's the quality of life difference? Maybe it's gifts to kids or grandkids. That whole composite understanding of what you want to do with extra money when you have it in your lifetime, and ways you can put your foot on the gas or take it off and even hit the brake. These all become part of the nuance of this conversation. When he's laying out a study like this, or we're laying it out on the table, it's helping show how much nuance is actually here once you've started this process.
Yeah, I think the thing I'll add is Matt has a great quote that I use often, especially where you've already won the game. Like if you have enough in assets where like you don't need 4.7% withdrawal rate actually to do everything you want to do and gift and keep living life. It's like, let's say it's 3.5 and we're pushing you to 4, like to spend more money. Do you need to take more risk when you've already won the game of you've saved enough money, you have the withdrawal, you have everything that you need in life and want, and more money doesn't change the purpose or your happiness level or maybe your peace level. That's where I think like if you have a client that's like, I need more because of maybe these fixed expenses, or hey, our healthcare costs are kind of going through the roof. Like that's where this 1% glide path makes a lot of sense. And that's, I think, the practicality of where the rubber meets the road between the guide and the actual practitioner and the planning of it all.
Just one more clip quickly before we wrap up here. I know Matt loves himself a good bucket strategy, so I had to make sure to get this in at the end. So here's Bill talking about that.
Let's talk a little bit about cash reserves and sort of a bucket strategy, as you've called it. How do you think about that, especially with regards to weathering bear markets?
Sure. Well, I think in effect, my own research incorporates a bucket strategy because it has a 5% cash component in it. It doesn't separate the stocks and bonds. Some people add another, like a intermediate term category. I don't know if that's necessary or not. I haven't read the literature that convinces me that that is a viable approach. I think just a simple 2-bucket approach works pretty well.
We've seen some great work, especially from Wade Fowle, on different types of withdrawal strategies, some of the dynamic withdrawal strategies compared to the fixed inflation adjusted withdrawals. Any thoughts on those? Do you think there's room for all of these things, or?
Yeah, I'm a great admirer of Wade. I think he does some fantastic work, and I read everything he writes. And I think there's a lot to be said for those dynamic strategies, although I haven't really been able to test one. I hope to do that within the next year to see if some gains can be had from adjusting your withdrawals to market conditions during retirement.
What do you think about the idea at the beginning of retirement of front-loading spending, taking more early?
I think that's a viable approach. I analyzed in my book. It fits in with a lot of the attitudes of retirees. They want to spend more when they're younger and maybe less later. To those who use that, it's a viable approach. It's just that you have to be prepared for the magnitude of the clip, the decline, let's say in the 10th year, if you had a decline in expenses in the 10th year, because it could be pretty substantial depending upon how aggressive one was initially in withdrawing. And if you can handle a 25, 30, 35% decline in expenses.
So yeah, can you guys just talk about this quickly? Because I think this is something you use maybe to some extent. So can you just talk about what the bucket strategy is and the use of it?
The simplest way we think of it, and bucket is just a great metaphor here to use, because we think about a vessel that we are filling with something, and then we're thinking about buckets, plural. So there's more than one vessel that we're filling with different things based on needs, and we can top them off. We can drain stuff out. So in a very, very simple framework that we will regularly use as a metaphor to explain this concept is you have your short-term bucket of stuff that you need to pay bills, live life. That's today, that's this year. It's shorter term. You have a third bucket where we skip forward and we go, I'm probably not going to touch anything in bucket number 3 for 10 years. And if I have way too much money, I might top off bucket 3 a little bit more. If I have 2 less or bucket 3 is growing at a huge clip, I can pull some out. But I'm really only thinking about that on the longest time frame. And then a middle bucket, a bucket 2, that's like, I don't think this is money I'm going to spend today, tomorrow, or even this year, but I might need it. And it's also doesn't belong in my long-term bucket, in my third bucket, where I'm not going to touch it for 10 or 20 or 30 years. It's a mental accounting exercise, but it's really useful as a metaphor because in transition periods in particular, it's how we start to frame out the buying of time without talking about the parts of the market that we can't forecast, assume, correctly say, we know this is what's going to happen. So if you're going to retire in 5 years, we might have a lot of conversations about you have to build your bucket number 2. You've got the retirement accounts, keep those on autopilot. You've got the checking and the savings account and the operating account for the house and the life and the family. Keep that on autopilot. Bucket 2 is when you transition into retirement. If you retire and we have that 2022 scenario again, where stocks and bonds and everything goes down at once, we now have a withdrawal strategy to help buffer and limit the sequence of returns risk because we already have counted out the plan of here's money we need to pull forward and where it's going to come from. Likewise, if we get lucky and we retire and it's the beginning of COVID, but after the initial dip, and now it's just everything is exploding to the upside. Great. We have too much in bucket 2. My classic story is the clients who were very panicked about their jobs post-financial crisis, and they thought both of their companies were going to be consolidated, merged, and they were going to be let go, and they were going to be in this pre-Medicare phase of not having enough to pay for their healthcare insurance. The Cobras were crippling and punishing when we looked at them. So we went really, really hard on saving bucket 2 money for healthcare, and then Obamacare got passed. And all of a sudden they were like, wait, we lost our jobs. We have no income and healthcare is free, but we just saved like $200,000 for this. And now we just have this magic nest egg that was supposed to be spent. And that's why you do this, because you can't figure out what's going to happen next, but you prepare for that worst case scenario or that worst scenario that's on the table. And you can use buckets as a really convenient metaphor to explain this to people and clients.
Well, thank you guys for doing this. This is great because people see the 4% rule, but we just spent an hour talking about the details behind what should be a very simple rule. So I think it's really important just to think about how this applies in the real world. And so thank you guys for doing that. Thank you everybody for joining us, and we'll see you next time.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.